Welcome back to WealthWise, the podcast where clarity cuts through the noise and strategy paves the path to your financial future. I'm your host, Sarah. Today, we're diving headfirst into a topic that's buzzing on everyone's lips, yet shrouded in so much, well, let's call it educated confusion. Decoding the economic signals, the Fed, inflation, and your investment strategy on the cusp of 2025. It feels like every financial headline is a roller coaster, right? One minute things are looking up, the next there's a new twist. But understanding these shifts isn't just for Wall Street insiders, it's crucial for your personal wealth journey. So by the end of this episode, you're going to walk away with 1. A crystal clear understanding of what the Federal Reserve's latest cryptic signals actually mean for your wallet. 2. Insight into how a little-known factor called tariff inflation and looming economic forecasts could silently impact your savings and investments, and how you might need to adjust your approach. And most importantly, actionable strategies to not just survive, but thrive amidst market volatility, turning that uncertainty into a potential advantage. And to help us unpack all of this, I'm absolutely thrilled to have an incredibly sharp mind with us today. He's a seasoned market analyst, a trusted financial advisor, and someone who genuinely eats, sleeps, and breathes this stuff, so we don't have to get quite so lost in the weeds. Please welcome the brilliant Max Wise. Max, thanks for being here.
Sarah, it's a real pleasure. Thanks for having me.
Max, it's great to have you. So let's jump right in. The Federal Reserve, or the Fed, has been making some significant pronouncements lately, particularly around interest rates. We've seen their June meeting outcomes, and honestly, the reactions from Wall Street, from economists, even from everyday investors seem to be a mixed bag of optimism, skepticism, and outright confusion. From your perspective, why is this topic, the Fed's direction and its economic implications, so misunderstood right now, especially for individual investors trying to make sense of it all?
That's an excellent starting point, Sarah, because you've hit the nail on the head. The market is absolutely in a state of, let's call it, anticipatory suspense. Everyone's holding their breath. The Fed's recent June meeting is a perfect example of why this confusion arises. They essentially delivered two messages that, on the surface, can feel contradictory. First, they stated they're not looking to cut interest rates right now. But then, almost in the same breath, they indicated a plan for a couple of interest rate cuts before the end of 2025. This immediately creates an environment of ambiguity. It's like a traffic light showing both red and green simultaneously. This ambiguity feeds into several common misunderstandings that I see all the time, particularly among individual investors. The first major misconception is the idea that the Fed's word is gospel and their plans are set in stone. The reality is, Fed policy is incredibly data-dependent. Their statements are forward guidance, not unbreakable promises. For instance, even after the Fed's recent meeting, a prominent economist from JP Chase came out saying they still only anticipate one rate cut this year, likely at the very end in December. That tells you there's a healthy dose of skepticism even among seasoned professionals who are essentially saying, we'll believe it when we see the actual cuts. They know the Fed will pivot if the economic data, inflation, employment, GDP growth, doesn't align with their current outlook. The second big misunderstanding is that interest rate cuts are always a good thing, a sign of a booming economy. Not necessarily. While lower rates can stimulate borrowing and spending, aggressive or unexpected rate cuts can also be a signal that the Fed sees significant weakness or potential recessionary pressures on the horizon. It's a tool to prop up a struggling economy, not just a celebratory measure. So the reason for the cuts matters as much as the cuts themselves. And then, Sarah, there's a newer, more nuanced factor that Chairman Jerome Powell has been emphasizing, which many people haven't fully grasped the impact of: tariff inflation. He's been quite direct, stating, and I quote, "The cost of tariffs has to be paid." What he means is that these tariffs, taxes on imported goods, inevitably lead to higher costs for businesses. Those businesses then, more often than not, pass those costs on to consumers in the form of higher prices. This complicates the entire inflation picture immensely. If the Fed cuts rates while this underlying tariff-driven inflation is still a threat, they risk pouring fuel on the fire. Think about it from a real-world perspective. We've all seen how markets react, sometimes wildly, just to rumors of new tariffs being imposed or existing ones being paused. One week a tariff is announced, and certain sectors brace for impact. Supply chains get nervous. The next, it's delayed, and there's a sigh of relief. This constant back and forth creates a fog of uncertainty. For the average person, it's incredibly difficult to plan. We're already starting to see the prices of certain goods inch up, and Powell himself has predicted we'll see more of this inflationary pressure from tariffs as we move through the summer. This is precisely why he's hesitant to cut rates aggressively right now. He doesn't want to exacerbate that tariff-induced inflation. So you have these mixed signals from the Fed, these common public misunderstandings about what their actions mean, and then this wild card of tariff inflation. It's a complex cocktail, and it's no wonder people feel a bit lost. The key is to look beyond the headlines and understand the underlying mechanics. And that, I believe, sets us up perfectly to delve into the core insights of what this all means for our listeners' financial strategies.
That's a fantastic breakdown, Max. You've really painted a clear picture of why this is such a challenging landscape to navigate. So, with that foundation laid, let's move into those core insights. How do we, as individuals, start to make practical sense of these economic forces for our own financial well-being? That's a fantastic breakdown, Max. You've really painted a clear picture of why this is such a challenging landscape to navigate. So with that foundation laid, let's move into those core insights. How do we, as individuals, start to make practical sense of these economic forces for our own financial well-being? Okay, Max, let's start with that tariff inflation you mentioned. Chairman Powell explicitly said the Fed is, and I'm quoting here, waiting to understand what will happen with the tariff inflation. This seems to be a key piece of the puzzle. Can you break down for us exactly what tariff inflation is in simple terms, and why it's making the Fed pump the brakes on potential interest rate cuts, even when other indicators might suggest they should ease up?
Absolutely, Sarah. It's a crucial point because it's a layer of complexity that isn't always front and center in mainstream financial news, but it has a very real impact on everyone's wallet. Think of tariffs at their core as a tax. Specifically, they're a tax imposed by a government on goods and services imported from other countries. So if the U.S. decides to put a 25% tariff on, say, electronic components imported from country X, the American company bringing those components in suddenly has to pay 25% more for them. Now, that company's faced with a business decision. They have a few options. One, they can absorb that extra cost themselves. This means their profit margins shrink. For some large companies with hefty margins, they might do this temporarily for certain products, but it's not a sustainable long-term strategy for most, especially small to medium-sized businesses. Two, they can try to find a cheaper supplier from a different country, not subject to the tariff, but this takes time, involves logistical challenges, and might not always be possible or offer the same quality. Or three, and this is the most common route, they pass that increased cost on to the next person in the chain. Often, that's other businesses, and eventually, it's us, the consumers. So the price of the final product, whether it's your new smartphone, your washing machine, or even the cost of services that rely on imported goods, goes up. That's tariff-induced inflation or tariff inflation. The reason Chairman Powell and the Fed are so focused on this is because it's a type of inflation that's not necessarily driven by an overheating economy or excessive consumer demand in the traditional sense. It's a supply-side shock, an artificial cost increase imposed by policy. Powell is essentially saying, look, we're already dealing with existing inflationary pressures. If we start cutting interest rates now, which typically stimulates demand by making borrowing cheaper, while this new wave of cost-push inflation from tariffs is just beginning to ripple through the economy, we could make the overall inflation problem significantly worse. It would be like trying to put out a fire in one room while someone is squirting lighter fluid in another. He even stated, we are beginning to see some effects of tariffs, and we do expect to see more of them over the coming months. this isn't just a theoretical concern. For example, if new tariffs are broadly applied to consumer electronics or apparel, two major import categories, you can bet we'll see those price tags climb. Imagine the cost of back-to-school shopping or replacing your laptop suddenly jumping by 10 to 15% purely due to these new import taxes. That's real money out of people's pockets. So the Fed is in this delicate balancing act. They don't want to keep interest rates unnecessarily high if the economy is genuinely cooling, but they can't also ignore the very real threat that tariffs pose to their primary mandate of maintaining price stability. They need to see how significant this tariff inflation will be, how widespread its effects are, and how businesses and consumers react before they feel comfortable making borrowing cheaper. It's a complex, multivariable chess game, and they're trying to make the right move without toppling the whole board.
That explanation really clarifies why tariffs are more than just a political headline. They have direct economic consequences. It's like a hidden tax that slowly creeps into everything.
Precisely, and that leads us to a key takeaway for this part of our discussion. Tariff inflation is the stealthy X factor in today's economic equation. The Fed is essentially hitting pause, trying to solve this tricky variable before rewriting the playbook on interest rates. Hashtag Fed, hashtag inflation, hashtag tariffs.
Okay, Max, moving on from the specifics of inflation, let's broaden the lens to the overall health of the U.S. economy. Beyond inflation concerns, the Fed has also released forecasts that hint at a potential economic slowdown and even a slight uptick in the unemployment rate heading into 2025. Powell himself acknowledged the U.S. economy has, in his words, defied all kinds of forecasts for it to weaken, which is true. It's been surprisingly resilient. But if the Fed itself is now projecting a cooling off, what does that practically mean for our listeners, especially for younger people building their careers and for investors trying to navigate their portfolios?
That's the million-dollar question, Sarah, because it shifts our focus from prices to paychecks and profits. You're right, the U.S. economy has been remarkably robust. Many analysts, myself included, have been surprised by its persistent strength despite headwinds like high interest rates and global uncertainties. However, the Fed's latest projections are now signaling a gear shift. They're forecasting, for instance, that economic growth might slow to around 1.4% instead of the previously anticipated 1.7%. Now, those numbers might seem small, but in the context of a multi-trillion-dollar economy, that's a significant tempering. More tangibly, they're also suggesting the unemployment rate could nudge up, perhaps to around 4.5% from its current very low levels. The key message here is that both the Federal Reserve and likely the broader government expect the economy to cool down or normalize after a period of unusually strong post-pandemic recovery and high inflation. So, what does this mean for different groups? For workers, especially younger individuals or those early in their careers, a cooling economy often translates to a more competitive job market. When businesses anticipate slower growth, they might slow down hiring, be more cautious about expanding, or even look for efficiencies. This doesn't necessarily mean widespread layoffs like in a deep recession, but it could mean fewer open positions, more applicants per job, and potentially slower wage growth or fewer opportunities for rapid advancement. For someone just starting out or looking to make a career jump, this means being more strategic, perhaps upskilling, and really focusing on demonstrating value. The days of easily hopping to a new job with a 20% pay raise might become less common for a while. For investors, a slowing economy generally has direct implications for corporate earnings. If consumers are tightening their belts and businesses are investing less, company profits can take a hit. This in turn can affect stock prices. Sectors that are highly cyclical, meaning their fortunes are closely tied to the economic cycle, like consumer discretionary goods, think new cars, luxury items, or industrial companies, might feel this more acutely. Investors might need to become more selective, focusing on companies with strong balance sheets, resilient business models, and the ability to perform well even in a slower growth environment. It's important to note Powell's careful language here. He said something along the lines of, "The concern about a recession is not here right now," which is reassuring. He's not waving a red flag for an imminent crash. However, he also acknowledged that the risks of higher unemployment and higher inflation have risen. That's the key nuance. It's not panic stations, but it's a signal that the easy ride might be over, and we're entering a phase where economic vigilance and prudent planning become much more important. Think of it like driving. For a while, we've been on a smooth, open highway. Now the Fed is flashing a sign that says, "Caution, winding roads and potentially slower traffic ahead." You don't stop driving, but you might ease off the gas, pay more attention to your surroundings, and make sure your car is in good working order.
That's a very clear analogy. So it's less about doom and gloom and more about adjusting expectations and strategies for a potentially different economic climate.
Exactly. It's about preparedness and recognizing that economic cycles are natural. The U.S. economy, still showing muscle, but the Fed's signaling a deceleration ahead. For both your career and your portfolio, it's time to shift from cruise control to more active navigation. #economy, #jobs, #wealthwise.
Max, this brings us to a crucial point for everyone listening. We've talked about the Fed's cautious stance, the shadow of tariff inflation, and a potentially slowing economy. It sounds like a recipe for market volatility and investor anxiety. So, with all these uncertainties swirling, what's your advice on smart investment strategies? Specifically for our audience, many of whom are in their 20s and 30s, perhaps building their first serious investment portfolios, and are likely looking for long-term growth rather than trying to play the market or time its swings.
This is where the rubber really meets the road, Sarah, because all this economic analysis is only useful if it helps people make better decisions with their own money. And you're right, the current environment is a recipe for volatility. Wall Street notoriously hates uncertainty. And we have uncertainty in spades right now. Uncertainty about Fed policy, about inflation, about trade, about geopolitical events. When you have that much uncertainty, you get volatility, markets going up and down, sometimes sharply. This volatility often triggers a lot of emotion, fear when markets drop, FOMO, fear of missing out when they rise, and emotion is usually the enemy of good investing. A lot of people lose money not because they pick bad investments, but because they react emotionally to market swings. However, and this is critical, for a long-term investor, this is precisely why investing and continuing to invest is more important than ever. Volatility, while unsettling, can also create significant buying opportunities. So here are a few core principles for navigating this, especially for that 18 to 40 demographic focused on long-term growth. 1. Abandon the myth of timing the market. This is probably the single biggest piece of advice. So many people sit on the sidelines waiting for the perfect moment to invest, or they try to sell at the peak and buy back at the bottom. The reality is almost no one can do this consistently, not even seasoned professionals. Let me give you a concrete example. Think back to the sharp market drop in early 2020 when the pandemic hit. I was making videos then talking about why I was continuing to buy, and the comment sections were full of people saying, "You're crazy, it's going to go way lower." Many waited. Then the Fed opened the monetary spigots, and markets rebounded with astonishing speed. A lot of people who were waiting for the bottom missed a huge chunk of that recovery. We saw similar patterns in 2022 when the market corrected. People expected it to fall much further, hesitated, and then missed the subsequent rally. The point is, you don't know when the exact bottom is, and you don't know when things will turn. Trying to time it often means missing out. 2. Focus relentlessly on long-term asset accumulation. If you're investing for 10, 20, 30 years or more, which most people in their 20s and 30s should be, what happens in the next 6 months or even the next 2 to 3 years, while important to monitor, is not the defining factor for your ultimate success. Your primary goal should be to consistently accumulate income-producing or growth-oriented assets over time. Own more shares of good companies, more units of diverse ETFs, more real estate, whatever aligns with your strategy. Market downturns, when viewed through this long-term lens, actually become opportunities to acquire those assets at a discount. 3.
Maintain some dry powder, but don't hoard it excessively. Having some cash on the sidelines is smart. When you see those market downturns, those fire sales, having cash ready to deploy allows you to take advantage of them. It feels good to buy when things are cheaper. However, there's a balance. Keeping too much cash out of the market for too long, especially in an inflationary environment, means your money is losing purchasing power. So it's about having a strategic cash reserve, not letting fear paralyze you into holding all your wealth in cash indefinitely. 4. Invest in your own financial education and know your strategy. This is paramount. Personal finance is, as the name suggests, personal. What works for me might not work for you. Don't blindly follow a random guy on YouTube, as the video you shared rightly pointed out, or even me, without doing your own research and understanding how it fits your goals, your risk tolerance, and your timeline. Know what kind of investor you want to be. Are you comfortable picking individual stocks, which requires more research and carries higher specific risk? Or are you better suited to broadly diversified ETFs or index funds, which offer a simpler way to own a piece of the whole market? What's your strategy for adding money? Is it a lump sum or dollar cost averaging, investing a fixed amount regularly regardless of market fluctuations? The more you understand these things, the less likely you are to panic when markets get choppy because you'll have a plan you believe in. Think of it like building a house to withstand storms. You don't just throw some wood together, you have a blueprint, you use strong materials, and you build it systematically. Your investment portfolio is the same way. It needs a solid foundation of knowledge and a clear strategy to weather the inevitable economic storms.
That's incredibly practical advice, Max. The idea of not trying to time the market, but focusing on consistent accumulation and understanding your own strategy really resonates, especially in a world that often pushes for quick wins.
Quick wins can happen, but sustainable wealth is built on sound principles and patience. In the chaotic dance of volatile markets, your best moves are patience and a long-term strategy. Don't chase the market's fleeting rhythms. Build a portfolio designed to endure and grow. #investing, #long-term, #volatility, #wealthwise.
Max, that advice is incredibly valuable, especially the emphasis on long-term strategy and self-education over trying to chase fleeting market trends. It's clear you've learned these lessons not just through academic study, but likely through real-world experience, which is often the most profound teacher. And on that note, you've shared so many invaluable insights from an analytical perspective. I'm curious, in your own financial journey, Max, was there a specific turning point? Perhaps a significant failure, a costly mistake, or a hard-won breakthrough lesson from the market, an advisor, or even a personal crisis that fundamentally reshaped how you think about investing and wealth building, particularly during these volatile periods we've been discussing? Something that just clicked and changed your approach forever?
That's a great question, Sarah, because those moments, often the painful ones, are indeed the most formative, and yes, there absolutely was. For me, it goes back to the infamous dot-com bubble burst in the early 2000s. I was younger then, relatively new to serious investing, and, like so many others, I got completely swept up in the euphoria, the hype. It felt like a new gold rush. Every day there were stories of people making fortunes overnight on these tech stocks, many of which had no real earnings, no viable business model, just a .com at the end of their name and a grand vision. The prevailing wisdom, or rather the prevailing madness, was that the old rules of investing didn't apply anymore. This time it's different, they all said. Famous last words, right? I remember pouring a significant portion of my then modest savings into a couple of these high-flying tech stocks. I didn't truly understand their underlying businesses. I couldn't have explained their revenue models or competitive advantages if you'd asked me. My research largely consisted of reading enthusiastic online forums and seeing the stock prices go up day after day. It was classic herd behavior, classic FOMO. I was investing based on hope and hype, not on fundamentals. And then, as bubbles inevitably go, it burst, and it burst spectacularly. I vividly remember watching those stock prices plummet day after day. That green on my brokerage screen turned into a sea of red. The paper profits I dreamed of vanished, and then my initial capital started eroding rapidly. It was a brutal, humbling experience. I lost a not insignificant amount of money that, at that stage in my life, felt like a fortune. The feeling was, well, it was a mix of panic, foolishness, and a deep sense of regret. I'd wake up in the middle of the night checking pre-market quotes, which is never a good sign. But beyond the financial loss, which was painful enough, the real impact was the lesson it seared into my brain. It was a very expensive education, but perhaps the most valuable I've ever received in finance. That experience taught me 3 profound, non-negotiable truths about investing that I carry with me to this day and that I drill into anyone I advise. 1. Investing is not about following the crowd. The moment everyone is screaming buy about a particular asset and there's a frenzy of excitement, that's often the time to be most cautious, not most aggressive. Warren Buffett's adage, be fearful when others are greedy and greedy when others are fearful, became crystal clear to me. The dot-com bubble was a masterclass in crowd psychology gone wrong. 2. Truly understanding what you're investing in is infinitely more important than chasing quick profits. If you can't explain a company does, how it makes money, and why it has a sustainable advantage in simple terms, you probably shouldn't own its stock. The allure of getting rich quick is a dangerous siren song. Real wealth is typically built methodically through understanding and conviction in your investments. And 3, patience and a long-term perspective are your greatest allies, especially when the market is in turmoil. Panicking and selling during a downturn, like many did during the dot-com crash and many other crashes since, often locks in losses and causes you to miss the eventual recovery. If you've invested in solid assets based on sound reasoning, having the discipline to hold on and even add to your positions during downturns is key. From that point forward, Sarah, my entire approach shifted. I became obsessed with fundamentals, with understanding business models, with risk management, and with cultivating emotional discipline. I realized that building a solid foundation of financial knowledge and adhering to a clear, well-thought-out investment strategy is far more crucial than trying to catch the next hot stock or perfectly time market movements. And frankly, these periods of heightened uncertainty and volatility, like the one we're navigating now, only reinforce those core lessons. They remind me to stick to the principles that were forged in the fire of that dot-com bust.
Wow, Max, thank you for sharing that so candidly. That's a powerful story, and I think many listeners can relate to the allure of hype versus the wisdom of fundamentals. It's a testament to how setbacks can truly become our greatest teachers, and it perfectly underscores the long-term, educated approach you've been advocating throughout our conversation.
All right, Max. Looking through that lens of hard-won experience and your deep market knowledge, let's shift our gaze forward. We've talked a lot about the current complexities. If you had to pinpoint one major shift, trend, or dynamic in the next 3 to 5 years that you believe will significantly define financial success for individuals, what would that be? Where should people be focusing their attention to stay ahead of the curve?
That's a fascinating question, Sarah, because the financial landscape is evolving so rapidly. If I had to bet on one overarching theme that will define financial success in the coming 3 to 5 years, I'd say it's the rise of financial self-sovereignty and adaptive intelligence in the face of systemic uncertainty. Let me break that down. We're witnessing a confluence of powerful forces: persistent geopolitical tensions, the potential for more frequent trade skirmishes like the tariff situation we discussed, the varied and sometimes divergent paths of global central banks. Just look at Switzerland cutting rates to 0 while the Fed here remains cautious. Add to that the accelerating pace of technological change, like AI's impact on various industries and potentially on investment management itself. What this all means is that systemic uncertainty and rapid change are likely to be the new normal, not an occasional blip. The idea that you can just set a very rigid financial plan and forget it for a decade is becoming less tenable. Therefore, financial success will increasingly belong to those who cultivate 1. Adaptive financial planning. This means building a financial plan that is robust, yet flexible enough to adjust to unforeseen economic shocks or personal life changes. It's about scenario planning, having contingency funds, and regularly reviewing and tweaking your strategy as the environment shifts. For example, understanding how different inflation or interest rate scenarios could impact your mortgage, your savings, or your investment returns, and having strategies for each. 2. Continuous financial literacy and critical thinking. The sheer volume of financial information, and unfortunately misinformation out there, is overwhelming. The ability to discern credible advice from noise, to understand the fundamental drivers of economic trends rather than just reacting to headlines, will be a massive advantage. This isn't about becoming a Wall Street analyst, but about developing a solid BS detector and a framework for making informed decisions. For instance, being able to critically assess a new investment product or a viral financial hack, rather than just jumping on the bandwagon. 3. Intelligent diversification, beyond just asset classes. Yes, diversifying across stocks, bonds, and real estate is still crucial. But I think we'll see a greater emphasis on diversifying income streams, diversifying skill sets to remain employable in a changing job market, and perhaps even diversifying geographically, in terms of where some assets are held or where income is generated if appropriate for the individual. Think about the rise of fractional ownership in assets like real estate or even art, or the growth of the creator economy and side hustles. These are all manifestations of people seeking more control and more diversified pathways to financial well-being. The individuals who proactively build these layers of adaptability and self-reliance, grounded in solid understanding, are the ones who will not just navigate the uncertainties, but will likely find significant opportunities within them. It's about moving from being a passive recipient of financial fate to an active architect of your financial future.
Financial self-sovereignty and adaptive intelligence. I love that. It really speaks to a proactive, empowered approach rather than a reactive one. It's not just about what assets you hold, but how you think and adapt. That's a really powerful forecast, Max. Max, this has been an incredibly insightful and thought-provoking conversation. From decoding the Fed's intricate dance with tariff inflation to navigating the outlook for the U.S. economy, your personal story of learning from the dot-com era and that compelling vision for the future of financial success, you've given us so much to consider and, more importantly, to act upon. Thank you, truly, for sharing your wisdom and your time with us on WealthWise today.
The pleasure was all mine, Sarah. Thanks for the great questions and for fostering such an important discussion.
To everyone listening, if you found as much value in today's episode as I did, and you're ready to take your financial clarity and strategy to the next level, here are 3 simple things you can do right now. First, share this episode. If there's someone in your life, a friend, a family member, a colleague, who's trying to make sense of their finances or feeling a bit lost in the current economic climate, send this their way. A little bit of clarity can go a long way. Second, if you haven't already, please subscribe to WealthWise wherever you get your podcasts. We drop new episodes packed with actionable insights like these every single week, and we'd love for you to join our growing community of strategic wealth builders. And third, we'd love to hear from you. What was your biggest takeaway from today's conversation with Max? Do you have questions about the topics we discussed or suggestions for future episodes? Drop us a comment, send us an email. Your feedback helps us make WealthWise even better. As we close out today, I want to leave you with this thought. Navigating your financial future, especially in times of uncertainty, can feel daunting. But remember what Max shared and what we strive to reinforce here at WealthWise every week. Financial freedom isn't just a distant dream you hope to stumble upon. It's a deliberate strategy you build, one informed decision, one consistent action, and one learned lesson at a time. Thank you so much for tuning in. Until next time, keep seeking clarity, keep building your strategy, and keep wisely on your path to wealth.